It's time for our year-end review and predictions show. Ted is here to review our predictions from last year and give you our predictions for 2025. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. It is time for our annual year-end review show and predictions for 2025. Now, as you know, most people listen to the audio version of this podcast because they don't want to look at us.
Okay.
About 60% of those listeners are listening on Apple Podcasts. That is the most popular platform, apparently. Another 18% or so are on Spotify, with the remainder last month listening on 64 other podcasting platforms.
I had no idea there were
I had no idea
podcasting
either.
platforms.
We are everywhere. So
Apparently.
Today, for our listeners, I'm going to show some charts. So for you audio listeners, don't worry, we'll describe them. But if you're sitting at your phone or computer, you may want to switch over to the Debt Free in 30 channel on YouTube so you can actually see the chart. So why do we do this episode? Well, it's for my amusement. That's the main reason.
Right.
This is kind of my favorite one of the year. But it's also, I like looking at the numbers and I want to know what's going to happen so that you and I can decide what to do with our business.
Right.
Hoyes, Michalos and Associates, Inc. We're not just podcast people. We actually have a business to run. Are we going to be busy or not? And for you, the listener, everything we discuss will have an impact on your financial life. Should you ask for a raise at work? Should you look for a second job? Should you buy a house? Should you rent? What's going to happen with the economy in 2025? But there is another reason we do this. And that's because I believe if you can't predict the future, you really don't understand what's going on. Now, of course, we can't actually
with any kind of accuracy.
Yes, we are, as you're going to find out, not entirely accurate. But I think it's important to go through the thought process so that you can understand why you're saying what you're saying. So Last year, show number 487, we made some predictions. So let's see how we did, shall we?
Coincidentally, that was 52 shows ago.
I know, isn't that interesting?
How'd that work
How
out?
about that, eh? So yes, this is show 539. So let's see if you should be wasting your time listening to us this year. So I'm going to play 3 clips from last year's show and see how we did. So the first clip was us discussing what we thought was going to happen with inflation. So here's what we said last year. I took my computer and I made more squiggly lines, so you know it's legit. And what this tells me is that by the summer of 2024, the rate of CPI growth will be 0. So there's my prediction. I don't think there's anybody in the world who agrees with me on that. No, and as it turned out, I was completely wrong on that. In October 2023, which is the most current monthly numbers that we have when we are recording this, October 23 when we recorded it last year, inflation was 3.1%. Inflation did go down to 1.6% in September of 2024. So I got the direction correct, but not quite the magnitude. And you can see on the chart, that's how it went. So as we record this, the most recent numbers we have are for October of 2024 when the CPI change was 2%. So apparently my prediction of 0 was not correct.
Yep.
Now, the reason I predicted that, and I think you had predicted that it would be higher than that.
That was a safe guess.
But not as,
high as it was.
Exactly. So we were both sort of, we got the direction right.
So I was hedging my bets.
There you go. Exactly. Now, the basis for my prediction was the money supply. And I drew this beautiful chart, which I just love.
And everyone looks at this every morning over coffee.
Exactly. That's what we all do. So, M2, which is the amount of money that's out there, when it's going up, well, eventually inflation's going to go up. And then when it goes down, it goes down. So I drew the lines and I said, oh, well, you look at that, by the summer, we're going to be back to 0. Well, we weren't.
Right.
And you can also see that the line has now picked up again. Money supply was not going to fall forever.
Right.
So when you look at this chart, it pretty much tells you that, inflation is going to be going up in the future.
Right.
And I think you agree with that. Everyone agrees with that.
Correct.
Like, I cannot see the scenario where inflation, we could have 2 or 3 months where it continues to go down.
We could have a massive recession because of some sort of conflict throughout the
Yes,
world or
of course.
something.
There
That could
be-
destroy everything.
Could be things that happen, but at the moment that doesn't appear to be what's going to happen. So, okay.
Right.
So here is clip number 2 from last year. My big picture predictions are inflation has peaked. Interest rates have peaked. I think we're heading into a recession if it's not already here. Ted thinks it's going to be a little more muted than that. So, okay. I said inflation had peaked, and I think there was, see if we can advance this here. I think, well, obviously I was correct about that. Inflation
Right.
had peaked. And I said interest rates had peaked. And that was also true. And in fact, this is a tweet I sent out back when it was called the tweeting thing. October 10th, 2023, I said that the Canadian 5-year government bond yield had peaked on October 3rd. And sure enough, that's exactly what's happened. At that point, the bond yield was around 4.5%. And by mid-December of 2024, it was down to around 2.8%. So I think we were both correct on what was going on. And the reason I throw up the Canada 5-year bond yield is because this has a significant impact on mortgage rates. We typically get a 5-year mortgage. So that's why this is important. Now, does anyone really care what we think about inflation?
Well, no one looks at this chart either. So
that's right. Oh no, everyone looks at this chart. If you got a mortgage, you're looking at this chart. But let's face it, we are not the experts in that. The reason that the tens of millions of people are tuning into our little show today is to hear our predictions for the insolvency rate. So here is the final clip from last year. Our prediction on insolvency rate. So that's the clip I'm going to play next year. Insolvencies are going up. I don't see how I can possibly be wrong on that. The bigger question is by how much? So I am going to go with 30%. Okay. Which that's pretty much the same number I said last year. So I'm saying the same rate of growth.
It's going to continue.
So what do you think?
Right. And I'm very comfortable in that same range. I mean, I don't see any indicators for a reason for it to be slowing down. I also don't see it accelerating either. So,
well, that's what we said last year. We both said we were expecting about a 30% increase. And as we record this, the Office of the Superintendent of Bankruptcy has not released the November numbers yet. And obviously December isn't over, so we don't have December numbers. But based on my extrapolations, including the month of November, the personal insolvency rate in Ontario has increased in the first 11 months of 2024 by 18%. Right. So you and I got the direction right, but not the magnitude.
Yeah, and this has been a little confusing for us all year. It's been lagging more than we thought it could possibly lag. So I think the insolvencies are still out there and they're going to continue to increase. I don't know what actually caused the delay.
Yeah, and that's what we're gonna talk about on this show. So when you look at the numbers, it's kind of interesting. So I've got on the screen here a chart that you're never going to see anywhere else because I think I'm the only one who's still got the data going back to 1987. It's no longer available on the government's website. But not surprisingly, you can see a big, huge blow-off top in 2009. That was the credit crisis. A bunch of other things happened. Right. In September of 2009, in Ontario, there were 6,819 consumer insolvencies. Highest number ever, not even close since. In November of 2024, I'm projecting it'll be around 4,300, so 64% of that absolute peak. Now, you might say, well, you can't really compare 2009. Let's compare it to just before the pandemic. Okay, October 2019, 4247. October 24, 4882. So the absolute number of consumer insolvencies was certainly higher this year compared to before the pandemic, but even so, it's still only 72% of the pre-pandemic high. Now,
that's a 15% increase.
It is. So which is why for the year it was around 18%, most of which obviously has happened in the last year because it was going down after that. Now, I posted a chart like this on Twitter, and somebody said, well, you stupid guy, but you're not taking into account the fact that the population is a lot bigger. Well, that's actually true. The population is definitely bigger. Right. So I went in and crunched all the numbers, and I came up with this chart, which is the number of Ontario insolvencies per 100,000 people. Okay. And sure enough, we are nowhere near a peak. So September of 2009, there were about 52 insolvencies per 100,000 people. In November of 2024, I'm projecting that number is going to be around 27. So that is half of the peak. Right. Half of the peak. So that's kind of amazing, really. Like you would think that if the population grows by 10%, if everything's stable, the insolvency rate would grow by 10%.
Well, but I think 2009 was such an unusual because of the law changes and everything else. I'm not sure you should be using that as a reference point.
Okay.
Smooth it out.
Smooth it out, baby. Okay, here you go. So good point. So here is November 2019 and November 2024. On a per capita basis, it is a tiny bit lower.
right
this year than it was right before the pandemic.
Not on your graph.
Yep. If you figure out where November is.
Right.
But we are basically back to and slightly higher than the pre-pandemic levels on a per capita basis.
And it's trending upwards.
That's the key. It is trending upwards. So the big question then, fine, that's all past history. What's going to happen in 2025?
Mm-hmm.
So let's go through each of the different catalysts here, because there's a number of different things to think about. So I don't think this will shock anybody. Unemployment is a significant impactor of insolvencies.
If you're not sure about your income or don't have income, you're not spending money.
And if you are unemployed, you probably have to resort to debt to keep paying the bills.
Mm-hmm.
So in Canada, in November of 2024, the unemployment rate was 6.8%. So I've put up on the screen here a chart of unemployment going back, this is for Canada, going back to 1976.
Mm-hmm.
So 6.8% is, that's a relatively low number. I did a simple average of every single one of these months, and over the last 49 years, the average unemployment rate was just over 8%.
Right.
Okay, so 6.8%, we're at the low end of the range.
And
here.
economists all call for 5% full employment anyway, right?
Yeah, so I mean,
so it's not horrible.
When you just look at that number, that looks pretty good. But there are two caveats to this. The first one is it's rising.
Right.
So, okay, it's 6.8% now, but it's going up. And the second thing that is much more disturbing to me is that it is not evenly distributed across the population. So if you look at people 15 years and older, 6.8%, I just said that. If you only look at females between the ages of 20 and 24, it's 9.4%. And if you look at males 20 to 24%, it's 12.8%. So the males are a lot higher than the females, which is a lot higher than the general population.
And these are only that are participating in the workforce, right? Or want to?
Right. So
there's a big segment of that wouldn't even get caught in the numbers because they're not actively looking for work.
Yeah. Well, they're
students.
Right. This would be, you're right. These are the active participants. So, I mean, if you go to school, okay, you graduate when you're 21, 22, you're still probably in this cohort.
Okay.
So this really worries me because that first job is the one that leads to the second job and the next one, the next one, the next one.
Right.
You get off to a bad start. That's kind of a problem. So, and if you look at this just compared to a couple of years ago, April of 2023, and again, we're talking 25 to, let's talk 25 to 54 years old.
Mm-hmm.
That's pretty much the working age population.
Right.
Because Ted, how many people over the age of 54 are still working, right?
Just you and me.
Just you and me, man. We are both in our 60s, but we won't admit that publicly. April of 2023, 25 to 54-year-old in Ontario, 4.3% unemployment, Canada 4.4%. So Ontario, same as Canada.
Right.
Today, November 2024, Ontario has a 6.3% unemployment rate in that age group. Canada only 5.8%. So why is Ontario doing worse than Canada? Like, I don't know.
Yeah.
I mean, I assume Ontario has a bigger manufacturing base and that's been hollowed out. Ontario's had more immigration. Like, I don't know.
Probably we're larger recipient of immigrants.
And so that potentially has had an impact. So, and again, not surprisingly, if you compare the insolvency rate to the unemployment rate, pretty highly correlated. Now, obviously, we had a big jump up during the lockdowns, but the general trend tends to be unemployment goes up and insolvencies go up. And if you zoom in, the trend is somewhat clear. Obviously, there's bouncing around each month. You kind of have to smooth it out, but I think we can see that the trend is the trend.
Right.
And if you want to do some dubious speculation, well, I guess if the unemployment rate continues to increase at 0.1% per month, which is what it's been doing,
right.
And if the insolvency rate was to increase 30% next year, well, that's pretty much what the chart shows, right?
Okay.
Now, we know what happens when I just make up these charts. So
right. But the next one's quite telling.
Well, so let's talk about the other thing that has a big impact on insolvencies, and that is debt. Now, you predicted and have continued to predict that credit card debt would continue to go up. Looks like you're right.
Every month we get a new record.
So we had the big drop during the lockdowns in 2020 because you didn't have any money to spend.
You couldn't go out anyway.
Might as well just pay down my debt.
Right.
And it didn't take long to get back over that level, and now we're like way over that level.
Yeah.
We're not even close. And so, again, if you compare credit card balances, and I lagged them by 1 month, to Ontario insolvency rates,
pretty clear correlation.
Pretty clear.
Yep.
Credit cards go up, insolvencies go up. Now, the other big factor that I think is going to be a story in 2025 is real estate. So I would like you to explain to the listener what the Hoyes Michalos Homeowners Bankruptcy Index is.
Right. Well, so effectively, it's the number of our insolvent clients that have real estate. They own a home, a condominium, whatever that it is. And it peaked, well, my recollection, well, look at your graph. I don't need to remember.
Well, the absolute peak number, I think, was February of 2011 when it was just over a third.
Yeah, we had 1 in 3 of our clients.
And you can see that from 2009 to 2012, it was in that 30% range. And then it dropped.
Dramatically.
And we actually had a month or two in 2022 where the rate was zero. Not a single person who owned a home filed a consumer proposal or a bankruptcy.
With us.
And so why was that?
Well, you think back, real estate prices were going crazy at that point. Interest rates were still low. They hadn't started to increase. So people got into trouble. They'd refinance their home.
Yeah, if I got $50,000 in credit card debt, but my home went up by $200,000,
I'll just
get a line of credit, I'm good.
Yep.
And so far in 2024, that number has crept back up to just under 5%. And obviously it bounces around each month. What do you think that's going to look like in 2025? Higher or lower?
So the interest rates have come down some, and they're going to come down a little bit more, but not much. I think we're going to get primed at 2.75 or 3, and it's going to stay there because that's where it's supposed to be historically. So what's going to happen to this number? It's going to double.
It's going to double. There you go. So we're probably looking at somewhere between 8 and 10% of our clients.
Right.
I don't agree with you on the interest rates. I think the government has to get reelected. They've got to drive them lower, and lower.
Right. Which is just going to
make things worse. But what you said makes sense. They're probably closer to an appropriate level now. Now, according to what I've seen on the internet, so clearly it's true, high-rise construction in Ontario has been 80% of all new construction since 2018.
That's because the urban planners are telling everybody, don't put up a house, put up a condominium, put up a tower, more people in more density. That's what they're looking for.
And I mean, you certainly see that in Toronto. We definitely see it here in Kitchener where we are today. We're right on King Street in Kitchener. There's an LRT right outside our door, and there's a whole bunch of towers going up right around the LRT.
Correct.
Density. Now, I believe Ron Butler on X had said there's something like 100,000 new condo units scheduled for completion in Ontario over the next 2.5 years. Most of those were built for renters to rent out, not to be owner occupied.
Right.
Because they're all small. Mm-hmm. They're 300, 400, 500, 600 square feet. 5 years ago, when you signed up for your pre-construction condo and put down your deposit, you paid something like, well, it could have been $1,100 a square foot.
Right.
And over the next few months, year, 2 years, that condo gets completed because it takes 5 years to put up a tower. And guess what? It's only worth maybe $800 or $900 a square foot. I've already had a few calls from people who are supposed to close on a condo for $1.1 million. They put down a $100,000 deposit. They go to the bank to get the mortgage, and the bank says, "Oh, it only appraises out at $850."
Right. So the most we're actually going to give you is $700.
Right. And it's like, oh, you're $300,000 short. So what do you do?
Yeah. Where's it going to come from? So you either got to find the money or walk away.
And if you walk away, the builder can then come after you for that shortfall.
Correct.
And so I don't think all 100,000 people are going to go bankrupt as a result, but the number won't be zero.
Correct.
So when we're looking ahead to 2025, I think real estate is going to be a significant impact.
It's going to keep driving this.
Not in January maybe, but throughout the year it'll continue to be an issue. Now, you and I already talked about interest rates. I already put these charts up before.
Yep.
You are of the view that rates are going to come down a little bit from where they are,
right? But
not hugely. So if we're somewhere around, what are we at, 2.5% or something like that, 3% on the 5 year, you think it maybe goes down to 2.5%, something like that?
Yeah, no more than that.
And I mean, I have no idea. I'm not even going to make a prediction because what do I know?
Right.
I think they're definitely coming down. How far, who knows?
Well, you're right about the election, though. They're going to try to buy people's votes, but that'll just make things worse.
Yeah,
because there'll be a correction immediately afterwards.
Exactly.
So.
And I guess the other big discussion is, are we in a recession or not? So last year I said, we're in a recession. We're going to be in a recession.
How much Bitcoin do you own?
Well, you got put all your money in Bitcoin. That's Ted's advice.
Yeah.
Don't take any of our advice, by the way.
Please don't.
In case you don't understand sarcasm.
I don't own any Bitcoin.
Ted does not own any Bitcoin. What is the definition of a recession?
Well, so it's a decline in economic activity that lasts more than a couple of months.
Pretty simple, right? It's not a one-day thing.
It's 2 quarters or something.
Yeah, the typical definition is GDP goes down 2 consecutive quarters. So according to Statistics Canada, the GDP, real GDP, so this is even adjusting for inflation,
right.
So it's okay, it's not nominal, increased 0.3% in the third quarter after rising 0.5% in both the second and first quarter.
So you can't have a recession if it's going up.
Right. Now, number one, do you believe the numbers? And we're not going to get into that discussion.
Right.
I mean, GDP is you add up everything, all the goods and services. I don't know how they do that. Obviously, they're taking an estimate or something.
Yep.
And obviously, GDP will go up in nominal dollars because if you got 5% inflation, if everything stays the same, the number goes up. But they're adjusting for inflation.
Mm-hmm.
So on that basis, we're not in a recession. Everything's good. But on a per capita basis, so explain what per capita means and what are the numbers we're seeing.
So per capita is on an individual person's basis. So if you have 100 people and the income was $10,000, your per capita income is what, $100?
Yeah. And so when you look at the chart on a per capita basis, GDP has gone down.
Right.
And it's been going down for, on a per capita basis, GDP fell 0.4% in the third quarter, which was the 6th consecutive quarterly decline. So in my world, if things go down for 6 consecutive quarters, that's a recession.
And it only takes 2. So
yeah. So I'm going to give you 2 scenarios here, and you tell me if they're the same. Scenario number 1: I go out, I take my axe, I chop down a tree, and I mill it or whatever you do with a tree, and I build something. Okay. That's scenario number. Scenario number 2: I use my credit card to buy the wood, and I build something. So on a GDP basis, isn't that the same? Like I built the same thing.
GDP, well, sure, because the wood's got to come from somewhere, so somebody did the work, so that you purchased it as opposed to it doesn't get duplicated.
Yeah. So at the end of the day, I built this structure that I can sell for $1,000 or $1 million or whatever it is.
Yep.
But the difference is one of them was financed.
Right.
And so isn't that going to have some impact on the economy at some point in the future?
It's got to. So it's because every dollar you spend today and borrow and have to pay interest on means you don't have that dollar available to spend tomorrow.
Yeah. So you've pulled it forward.
Yep.
Is what you've done.
You borrowed from your future.
You borrowed from your future. So here is why I think we are already in a recession. Real GDP has fallen for the last 6 quarters. Mm-hmm. That seems to me like a recession thing. Unemployment is rising, and it's high, particularly if you're a 20 to 24-year-old male. A lot of our GDP is financed by debt.
If evidenced by nothing other than credit cards, other thing,
and
everything.
The government debt.
Yep.
And as a result, insolvencies are rising. So now we get to the predictions. So I think the catalysts, if you want to call them that, in 2025, unemployment. Mm-hmm. So do you agree that it will likely continue to go up? Or do you think it's already topped out and everything's great? No,
so the wild card in the unemployment is what are all the changes to immigration going to do to change that number? So if everything was status quo, stayed the same, I believe it would still be going up. Because of the decrease in immigration coming through, it may actually decline.
Because you're taking some from the top and some from the bottom, the numerator and the denominator.
Right.
And you and I aren't smart enough to predict what's going to happen. It certainly appears that a number of immigrants are leaving, either voluntarily or not so voluntarily, and there will be many fewer coming here because it's like, well, if everybody else is leaving, why would I be coming to a place where the unemployment rate is high and everything is bad? Okay, number 2 is household debt. Do you expect that to go up or down?
It's going to continue to increase.
That's a no-brainer.
Yep.
It's just
don't even have to think about that one.
Keep going up. Number 3, real estate. You expect it to be softening, getting strong. Like, what do you think is going to happen there?
Well, so the issue with real estate is the interest rates will stabilize at something a little lower than what we already talked about, or maybe lower still because of the election. So that's going to make real estate affordable again. But I think everybody right now is still terrified. So the market's going to play soft.
Yeah. And does it, I agree. Does it make it more affordable, but doesn't make it affordable?
Well, that's a different conversation.
So, okay, I can afford a $3,000 a month mortgage payment. Right now to buy the house I want, it's $5,000. And with interest rates going down, it'll go down to $4,700. There's still no way.
People find a way. That's
well,
the
if you got family or something else, or there's two of you or whatever. But yeah, I don't see some great boom coming in real estate just because interest rates went down a little bit. Right. If you're unemployed, doesn't matter what the interest rates are.
Correct.
So we already talked about interest rates. The other one is the wealth effect. So the stock market, as we record this, just before Christmas, has been going up, forever. It's been the greatest thing ever if you happen to own those 7 stocks that have been going up.
Right.
And of course, as you said, you're a big crypto guy. It's record highs in December. Everything is great. You feel better when you look at your RSP and you go, oh, it went up 20% this year. That's fantastic.
So obviously I have more money I can spend.
So I feel better. Do you expect that to continue, or do you have any opinion one way or the other?
No, the market, I'm assuming the market has to correct. And not sure how much, but it's going to be something.
Yeah, I agree too. And I have no idea when. Maybe it'll go up another 50% before it crashes. I have no idea. So again, these are the things. Now, there's a whole bunch of other wild cards.
Right.
There's a new president coming in, we think, in January.
Right.
And he's said, tariffs. Come on, tariffs. You don't believe that.
I don't. I think the tariffs are just part of his operating style. I'm going to scare the crap out of people, and then it gives me someplace stronger to negotiate.
Right.
From.
And I agree with you. He may put some tariffs in, some selected tariffs, but some blanket tariffs on everything. I mean, Canada sends a lot of stuff to the U.S. They get all their natural gas from us. We send a lot of crude oil for refining the whole bit. And everybody goes to Florida. So I can't see him being quite that stupid. But I agree. I think it's a negotiating tactic. We've got a Canadian election in 2025. I have no idea what the impact is going to be. My opinion is I don't like any of them. That's my opinion.
None of the above.
Don't ask me to
Sounds
support
like a movie.
Yeah, whatever party you're with, I'm not with you. We've got all the conflicts that are happening around the world. Yep. Obviously not a good situation. The postal strike ended, but there's a huge backlog from that. And how many businesses ended up going under or being severely curtailed by that? I don't know. Don't have any numbers.
And then there's always the unknown.
And then the unknown. Yeah, what haven't we considered?
Aliens landing.
Well, and apparently that's probably going to happen. Maybe it's already happened. You might be watching this from the alien ship. So, okay, so let us close the show then with predictions. And the only prediction that really matters is what you think is going to happen with consumer insolvencies. So just to reiterate, last year we both predicted a 30% increase. It looks like it's going to come in slightly less than 20%.
Right.
And we're not exactly sure why it was less than that, other than, hey, I can still keep borrowing.
Right.
So I've kicked the can down the road.
The part that confused us was we don't know why it was so slow to come about. But with record debt levels, unemployment where it is, insolvencies are going to continue to increase. The wild card here is how much do you think that's going to be?
And that's my question for you.
Well, let's say it stays at the 20% because I see no reason for it to slow down. And we were wrong about the 30.
Yeah. So just to be contrarian, I'll go with 30% again because that's been my prediction every year for the last 3 years now. And again, my reasoning is, well, at some point, unemployment, massive household debt. I think without the real estate market propping up a chunk of it, then that tips a bunch of people over. Right. And I guess, what's going to make the change from 20% to 30%? I would say, well, maybe it is real estate. So you got the people who can't close on their pre-con. You got people who just say, you know what, I got to give up my house.
Yeah, even though rates have come down, they still haven't come down enough for the people that bought when money was free, when they were paying 1% on their mortgage. Now, even at the current rate, so they're paying 4%. That's a huge difference in your monthly check. Yeah,
and there's still a whole bunch of mortgages that come up for renewal in 2025.
Third every year.
Yeah, and well, yeah, it's a big number. And so if I've got a mortgage that I got at 1.5%, and now I'm going to have to renew at 3, 4, 5, or 6%. I'm paying way more.
Yeah, and somewhere you got to come up with that extra $1,000, $1,200, $1,500 every month.
Right. And so do I borrow to make the difference? I mean, I'm not getting a bigger raise at work because we're already in a period of unemployment. So there's no doubt, we both agree insolvencies are going up. Will it be a quick rise, or is this really a story for 2026 and 2027? I don't know.
Right.
I guess people can tune in then and find out. So there you go. Our predictions are that insolvencies will go up somewhere between 20 and 30%.
There you go.
Next week, we return with episode number 540, our first show of 2025, where we will be discussing new legislation that comes into effect on January 1st, 2025. I haven't seen any recent media reports on this, so you'll want to tune in. We're going to discuss changes to the criminal rate of interest, because in 2025, the maximum interest rate charged by finance companies and payday loan companies is going down.
Right.
Is that good news, or could it backfire?
Well,
you and I will talk about that next week.
Right. Show 540.
Show 540. Look it up. Tune in next week to find out. We are on all those 65 different podcasting platforms, including Apple Podcasts and Spotify. Obviously, we are here on YouTube. So please like, subscribe, notification, leave a comment, smash the button. You know all the words right there, Todd or Ted. I don't even know your name. We've done 540 shows and I don't even know his name.
We start wearing a tag.
There you go. We got name tags for 2025. That is our show for today. If you've got any comments, you can leave them in the show notes. You can tell us why we're completely wrong and that you may be correct. Thanks for watching in 2024. Happy New Year. Until next week, I'm Doug Hoyes for Ted Michalos. That was Debt Free in 30. 31. It's pretty good. Yeah, I have no idea what's going to happen. It's I don't know why the lag is. I don't know. Like it's very bizarre.